Can you retire before age 50 with $3 million in retirement savings? Well, in this video, I'm going to go through a comprehensive early retirement plan of a couple that had saved over $3 million. Their ages 48 and 46, and they really just wanted to have the confidence that they can retire early and go spend some of the time that they've been putting off while working, doing the things that they love. And as we go through their financial plan, we're going to focus on the three foundational parts of early retirement planning that will have a huge impact on your ability to retire early as well. So we're going to focus on three things. But before we get into the three foundational parts of the plan, let's meet Bob and Sue. And I've changed their names for privacy, of course. And what you're looking at on my screen is essentially their financial picture as it sits right now. So currently Bob and Sue are age 48 and 46, like I talked about earlier. As far as assets go in the investment accounts here, Bob does have some employer stock around $290,000. A lot of people come to me and they do have that position, which is many of the reasons why people can retire early is employer stock. Number two, Bob and Sue have a trust, so a taxable account of around $670,000. And this is another good sign when people come to me when they have that taxable account, because it's really flexible as far as creating income, especially before you retire, especially before your 50s. It's a great account to have. Bob also has a Roth with around $115,000. Sue has a Roth around $85,000. We got Bob's 401k, which is around $740,000. Bob's rollover IRA, $650,000. And then lastly, Sue has her 401k of around $520,000. Other assets they have here, we do have their home, which they say is valued around $1 million. And then they also have a rental that is cash flowing, is around $550,000. So as far as investment accounts, that puts them at right about $3 million in total investments that can generate income for retirement. They do have some liabilities here. The only liability is going to be their mortgage, which sits at $500,000, and it does have a low rate on it. And the only other income source will be Social Security down the line. The full retirement age amount for Bob will be about $2,500. And we're actually slightly adjusting that down a bit because they are going to be retiring early, nearly 20 years before his full retirement age. And a lot of zeros are going to be factored into that earnings. And the same thing for Sue as well. We want to factor in a lower Social Security benefit. Now, it could be more, but to be more conservative, we're just adjusting a little bit downward here. So we know how much they saved, the account types, and what other types of income sources they're going to have later on in retirement. Let's start getting to these three foundational parts together, because these are the big three that can essentially make a big difference on your own early retirement. So let's start by looking at their withdrawal strategy. So we can start to understand how much they can expect to spend given their situation. And you can use this to help you get an understanding of how things might look if you are in a similar position. So I like to tell this story a lot, but I live here in San Diego. I often drive down the Coronado Bridge to see friends, go visit. And I'm very thankful that there are going to be guardrails on both sides of the bridge. And if I hit one guardrail, it's going to do two things. Number one, it's going to put a dent on my car. And number two, it's going to change my momentum so that instead of the momentum pushing me off the bridge into the San Diego Bay, it starts to shift me back towards the middle where it's safe. And this is a concept behind the system we use to help our clients understand how much they can expect to reasonably spend. And it's something that can make a big difference in your ability to successfully retire early. Okay, so what you're looking at now is essentially what we would define as their spending capacity. We can see that as far as income sources in the first year of retirement, we can expect they're still going to have their rental income, which is around $1,500 per month. And then as far as what we can expect to withdraw from the portfolio is around $12,200 here. So their total net income up here on the top is going to be around $13,500 just in those initial years of early retirement. And that's the baseline. So if I switch this back over to annual, that's around $146,000 per year in portfolio withdrawals at the start of it. And that's going to be because their expenses. Now, as far as expenses, we expect they're going to have around $97,000 or $8,000 per month in just their baseline expenses. That covers mostly everything. But those other variable expenses that will eventually go away is going to be their travel. They want to spend an additional $15,000 per year on travel, as well as they do have to also factor in their mortgage, which eventually will go away. And something interesting here, you're looking at their state tax. You notice that as far as estimated taxes, they're going to look at around 1.4% as far as an effective tax rate. And again, that's because we're taking from these very tax efficient taxable accounts and paying those long-term capital gains rates. Now, the reason why there is state tax is because they are in the state of California, where California does tax long-term gain income as ordinary California income. So let's start to look at what this might look like over their lifetime. Okay, so the picture that you're looking at now is essentially their income sources throughout their lifetime, right? So these first two big columns is, of course, their salary now. And we can see it stops here at the end of 2024 when they retire in 2025. The blue section at the bottom is going to be their rental income. That's going to go, and we're just projecting that's going to flow at a steady inflation rate throughout their retirement. And the pink portion is the important part. This is the portfolio withdrawals throughout their retirement. And you notice it's not going to be the same. It's not going to be a flat 4% taking the same amount for the rest of their lives. And you notice actually there's some cliffs here. Now they're dropping. Your portfolio withdrawals are actually dropping in 2041 and then continues to drop in 2043 when they start Social Security. And again in 2045 when she starts Social Security. And then finally down the line in about 2056, that's when portfolio withdrawals are going to be very, very small. And that's because we're factoring in the expenses that will go away. So looking at some of the details of their expenses, we can see the blue section here is their overall living expense. That's that $8,000 per month or $96,000 per year. And it's actually following what the research calls the retirement spending spiral, where they're going to spend more in those early years, in the go-go years. And then they're going to have the no-go years where spending starts to slow. The slow-go years, and then finally the no-go years, when literally spending is very little, and then it will ramp up towards the end because of healthcare costs. And that's the type of strategy that we're factoring into their spending. And we can also see, things like their mortgage payment is eventually going to go away. Any sort of private health insurance before Medicare is going to eventually go away. And this is kind of what it looks like visually over their lifetimes when it comes to expenses. Now, those were some projections, but here is where the rubber meets the road as far as withdrawal strategies. If the portfolio of Bob and Sue, which currently sits around $3.2 million, it's going to sit at $3.2 million when they retire. If it were to drop by about 42%, I'd have to give them a call and say, hey, look, we hit a guardrail. We need to make a small adjustment of around $460 here, which is about 5% as far as a monthly reduction. But the same can also be true on the upside of the portfolio. If the portfolio does grow about 5% here, we're going to call them and say, hey, you get a nice bonus, around $450 per month in additional portfolio spending. When you retire early, you have decades more of retirement, which means a lot can happen. Having a strategy where you can be flexible when markets decline and also give yourself a bonus when markets do well is how you strike the right balance of spending, not just relying on a 4% roll and adjusting for inflation the rest of your life, even during down markets. Now, they might ask the question that some of you were thinking and say, okay, I totally agree of being dynamic. It makes a lot of sense, but how frequently am I going to have to adjust my monthly income? So what we do is run some simulations and run through thousands of different scenarios through different markets based on how they're invested and how much they're taking out. And rather than testing a probability of success, whether their retirement is going to be successful or fail, what we do is we test the probability of them having to make an upward or downward adjustment with their income throughout their retirement. So if we test the plan here, the numbers show that it's actually more likely that they're going to get an increase. We can see an average increase every year of about 6% when we test the plan, versus on the downside, every 80 years or so, we can expect an average decrease of 6% as far as a downward adjustment. But what happens if there's a black swan event like the great financial crisis? Well, when we run through this, yes, there's going to be some decreases in income in October of 2008, as well as January of 2009, and then again, April 2009. There's going to be a $2,500 drop in income. So I'm going to tell them, hey, we got to cut back on spending. Otherwise, we're going to run out of money. But the good news is that further along, the market does recover where A few years later, they're able to bounce back and their income can come back up. And eventually in the future, the market does well where they're actually having more income than they would expect if they just followed something like the 4% rule. Now, we invest a lot of time and money into the systems to help our clients manage this, but the principles still apply. You need to have a plan that is willing to adjust when, not if, markets decline, so you don't spend down your portfolio more than it can handle. But that leads us to the second foundational part, which is what sort of investments can change your retirement picture. Because having a great withdrawal strategy is going to be worthless if you don't have the right investment plan that coordinates with it. So before we dive in, I want to make this clear that the investments I'm about to show you on my screen here are not investment recommendations. You need to do your own research and your own due diligence. Again, the examples I'm going to show you are just for illustrative purposes only and should not be relied for any sort of basis for an investment recommendation. But let's go in and let's compare essentially what their portfolio looked like as they approach us before retirement and see how their investments might change when they do actually retire early. So here's a total portfolio analysis that we do with clients. And these are looking at the positions across their different accounts here on the left side, not the exact investments, but these are very close proxies for what they had. And we're looking at both their 401ks did have target date funds, S&P 500 target date funds. You have VU, which is an ETF that tracks the S&P 500. They do have a bond fund in which they're using TLT, which is a 20-year treasury fund in their trust because they knew they wanted to create income. We have the employer stock position right here. I'm using Amazon just as a placeholder, not the actual company they had, because it will have similar growth, similar type of makeup of what they did have. And lastly, they have QQQ, so a lot of big tech in the mix. So these are the funds that made up their entire investment portfolio altogether. And on the right, we have the proposed portfolio. Again, this is not a recommendation, but the allocation is more in alignment with the goal of an early retirement here. What we said here was, why not have more global diversification, not just in the US, but also international? And what if we own shorter term bonds, smaller cap funds, treasuries, emerging markets? And this is all done very intentionally. Each fund has a specific purpose. It's not just a hodgepodge of funds and to throw together for the purpose of diversification. And that's because the math changes when you do retire early. You want to make sure you have multiple return streams. Now, when they came to us, they said, hey, we already planned this out and we did have some bonds and TLT in the brokerage account since they plan to take income from there first, and they're exactly correct. The problem is that they were only halfway there. For example, 20-year bond funds like TLT have done really well, especially in the past 15 years when interest rates were declining. But when interest rates increased in 2022, these bond funds that are supposed to be relatively safe dropped nearly 31%. And this is even worse of a drawdown than the S&P 500 had in 2022. Versus on the right, we have funds like a Vanguard short-term treasury, which is not going to grow a ton. And we're not trying to chase yield here, but what it will do is provide a sense of stability for you and liquidity that you can rely on throughout your retirement. Again, during years where markets are doing well and these other funds like the smaller cap or the US markets are outperforming, we can start to slice off some of the growth and use that for income. But when we go to years like 2008, we don't want to sell from these funds while they're dropping in value. We want to make sure we have some positions that can give us a few years of steady income. And then on top of that, we also have a money market fund and a total bond market fund, where if markets still are bad, we have those to hold up your income before we have to sell from any other equity investments. So these again are not investment recommendations, but the concepts behind the asset allocation that I'm showing right here are pretty important when it comes to creating retirement income, especially for an early retirement. The other big factor is that 10% of the net worth was tied to that one individual stock, and that stock happened to have a ton of overlap with like QQQ. So they really weren't getting much of a diversification benefit, which was fine while they were working, but again, the math changes when you retire early. And yes, the US stock market has done extremely well over the past decade, but again, this is called recency bias. And I'll pull up this chart right here. And basically, the 2000s were a little bit of a different story, where the annualized return of the S&P 500 was actually a negative, where emerging markets at that point were actually one of the best performers. So I just went through the asset allocation, but let's talk about the asset location, because for Bob and Sue, we don't just want to put 70-30 in all their accounts. That's not a tax efficient way to build a portfolio. And we know that from looking at their withdrawal strategy, the more tax efficient way of withdrawing money for them was starting with that taxable account first. So if you look at their first year's withdrawals, which is around $144,000, $146,000 in that taxable account, and we have $0 coming from their pre-tax accounts, What that tells me is we want to start thinking about layering some of those shorter term bonds and conservative investments in their taxable accounts, because we're going to be taking income from there first. And because they're retiring early, we don't want to start taking money from those pre-tax accounts, because that's going to cause an early withdrawal penalty. So we're going to want to wait until, for example, 55 or 59 and a half to be able to take from those 401ks or IRAs. So all their taxable accounts might look more like a 30% growth and 70% conserved allocation. And of course, a taxable account is one of the accounts that most folks come to talk to me about. They also probably have high capital gains in most circumstances. We want to position this in retirement, but we don't want to just rip the Band-Aid off all the time when it comes to tax planning. We want to be able to strategically allocate this bit by bit. Whereas with the retirement accounts, we can think of those in terms of long-term growth, which of course we can change investments and position them right away to be more long-term growth without any sort of tax consequence when you sell within those accounts. Of course, that won't be the case forever, because things change over time. And for them, the required minimum distributions are eventually going to kick in, and their planning strategy might change, tax law might change. This is why you need to really monitor this and have a good plan on an annual basis. And you can't just set your portfolio up and just completely forget about it, because things change throughout retirement. And I hope you can understand that having the right withdrawal strategy and asset allocation is critical for the success of your early retirement. But let's go through the third and final foundational area of the planning, and that will be the tax planning. And tax planning is often a big missed opportunity for those that do plan to retire early. And if we take a look at a tax projection over their retirement and start to focus on how we can be strategic in lowering their lifetime tax bill, for them, we can see that when we're projecting out the yellow lines here, and a little spoiler, you can see in the blue what I'm going to talk about next. But if we're looking at the yellow lines, they're in a position where they're going to pay very little tax up front early on retirement, but then we can see once we get to 2052, 2053, their tax bill is going to start to skyrocket. And that's for two main reasons. Number one, if we do take the approach of taking taxable, then tax deferred, and then finally tax-free accounts, we end up in a situation where, again, very little tax is paid generally really early on. But again, once they get to retirement, they start getting crushed in required minimum distributions, where they might have to take out more income than they really even need. And the IRS is not so patiently waiting for you to do this, where they might take anywhere from 30 to 40% of their account in taxes, depending on the growth of the account. And secondly, again, because they're retiring early, and we're gonna have the long time period before any sort of Social Security kicks in, a time where, again, little income's actually taxable because of the favorable treatment of long-term capital gains in their taxable accounts. So you probably are seeing it on your screen, but I'm gonna shift over and show you how, if we're strategic in the way we actually pay taxes through strategic Roth conversions, what that can do for their retirement. So I'm going to pull this over to the right here. So when we ran a Roth conversion analysis, we found that converting dollars up to the 12% tax bracket while they're taking income can potentially save them over $1.3 million in taxes, as opposed to just waiting until required minimum distributions kicked in, where they're forced to take money out. We also can see that their average tax rate dropped by around 7.7%. So if you're strategic, filling up some of these lower tax brackets, like the 12% tax bracket in their circumstance, you can save yourself from getting crushed in taxes later. And that money moves from those pre-tax accounts to Roth IRAs. And guess what? Your Roth IRAs do not get hit with RMD. So if you start to move this money strategically, it can potentially create millions of dollars for you. And this is really important. And if you do this well, this means a whole lot more income for yourself throughout your retirement. So tax planning is one of the factors that not many advisors are doing, and it's one of the most overlooked dynamics when it comes to early retirement planning. And if done, of course, it can provide huge value for you. But Roth conversions can also be dangerous if you don't do them right, and it can actually end up costing you. So you definitely want to check out this video I made on what you should avoid before you start doing Roth conversions when you retire early. You can click here to watch. Again, this is Matt. I'm a certified financial planner and advisor with Wondery Advisors. If you'd like to talk to me or someone on my team about your early retirement plan, you can click the link in the description and chat with us. Thanks for watching. And again, I will catch you guys on the next one.